Every aspiring entrepreneur starts with that same shimmering promise, a great idea. Maybe it's a revolutionary new app or a new way to deliver a service, something the world just needs. And that sounds simple enough, right? Just find a great idea, build a great product, and, well, the market will reward you.
If only. I mean, if only the world actually operated on that simple equation.
Hmm.
The truth is, the gap between that brilliant idea and a successful, and this is the key word, scalable high-growth business.
Yeah.
It's huge. We're talking about a machine that's designed for rapid expansion, for outside investment, and maybe an eventual acquisition or an IPO.
Mhm.
That gap is vast, it's complex, and it's just filled with these non-obvious traps.
And that's really the core of what we're here to unpack today. We are not talking about starting a lifestyle business, a small shop. We're talking about building a venture that's designed from day one to issue stock options, to attract serious money from angels and VCs, and to multiply its value, exponentially. And our sources, which really lay out a definitive checklist for this exact journey, they warn us that the stakes are incredibly high.
They really are, because this whole path is governed by securities law and, frankly, by investor demands. So even small, seemingly insignificant structural mistakes that you make in the first 6 months, like failing to file the correct tax paperwork or improperly splitting up the equity among founders, these can result in these painful 5-figure, sometimes even 6-figure cleanup costs down the road. And that's money that should be going into your product, not into fixing avoidable legal errors.
So our mission today is a deep dive into the 25 key action steps that are required for this very specific type of high-growth company. We're really hoping to provide the whys in addition to just the what's and how's. We need to equip you, the listener, with those foundational principles that investors absolutely demand and that are, frankly, essential for your own long-term protection and success.
And we'll be your guides through this often very intimidating material.
Okay, let's start to unpack this blueprint. We've broken this deep dive into 3 major phases, which really mirror the entrepreneurial journey itself. So first, we're going to look at preparing to launch. This is all about establishing that essential, scalable foundation that gets your concept investor ready. Second, we'll move into building the core, so the nuts and bolts of people and paperwork, which is, like you said, often the most legally perilous phase. And finally, we'll tackle launching operations, finance, and measurement. Before we conclude with raising funds and planning the exit, because, every startup really needs to know how the story might end before it even begins.
That's right. The end has to be in mind from the beginning.
All right, let's start with that foundation.
The first, and I would argue the most critical hurdle, is a conceptual one. It's distinguishing your cool product concept from your core business concept. So many founders, they fall in love with the thing they're building, the widget, the app, the algorithm, but they fail to define the mechanism that actually turns that thing into scalable wealth.
That distinction is just paramount. A product concept is about features, right? But a business concept is about fundamental value exchange. You could build the world's best new collaboration app, but the business concept has to answer those key questions. What value are you bringing? To which specific customer segment? And critically, how are you capturing enough of that value that the customer is willing to pay you enough to sustain that exponential growth? If you don't have clear, profitable answers to those, our sources basically warn you that you have an expensive hobby, not a scalable business.
Exactly, an expensive hobby. And to move that hobby into a scalable business structure, the sources really emphasize using the business model canvas. We can't recommend this tool enough. It's a 9-element visual tool, and it forces founders to think through the entire ecosystem of their idea instead of just, iterating on product features forever.
It's a holistic view. So let's map out some of the most critical elements for a scalable venture and how they all relate.
Okay, we start with the core, the value propositions. This is the specific problem you're solving, or the unique bundle of goods and services you're offering to a market segment. It's the why should they buy from you?
And this has to align perfectly with the customer segments. So the specific group of people or companies you're creating value for. If your value prop is focused on, say, high-end luxury, but your customer segment is price-sensitive students, well, the model is broken from the start.
Right. Then we analyze distribution through channels. This just defines how the business reaches those customer segments and delivers the value proposition. Is it direct online sales? A global distribution network? Affiliate programs? The choice of channel dramatically impacts your cost structure.
And this is where most founders focus, but they often misunderstand the implications. Revenue streams. This defines how the business makes money from the value it offers. We need to know if it's subscriptions, transactions, advertising, licensing, or, a mix. For a scalable business, that revenue stream should ideally be recurring and predictable, which is exactly why VCs love subscription models so much.
And finally, a realistic assessment of key resources is just essential. These are the assets. They could be physical, like a server farm, financial, like cash on hand, or human. And in the early stages, founders often neglect the human assets. They fail to recognize that these specific, scarce skill sets are a key resource that has to be acquired, either with equity or with high salaries. Thinking through all 9 of those elements really forces founders to make sure they have a profitable, self-sustaining model.
Okay, so once that model is mapped out, you hit what the sources call the scalability reality check. They outline these 5 ideal propositions of a hyper-successful business. You need a giant total addressable market. You need to be able to capture full market share quickly. The service has to have a high dollar value. You must maintain a high profit margin. And crucially, the business must get better as it gets bigger.
And as you noted, hitting all 5 of those is the unicorn standard. It's exceedingly rare. Let's use the source material's great illustrative contrast, the one between a traditional service business and a platform model. It really shows how scalability changes the whole game.
Right, so we start with the physical house cleaning business. If you tried to scale a traditional cleaning company nationally, the economics are just brutal. Every new city needs new office space, new vans, new employees, new training. The logistics are incredibly complex, delivery costs are high because of travel time, and the profit margin per hour is pretty low because of labor costs.
And what about the barrier to entry for competitors? It's minimal. Someone just needs a mop and a used car, and they're in business.
But when you pivot that business model, like an Angie's List or a Home Advisor does, the entire equation shifts. Their business isn't cleaning houses, it's lead generation and intermediating payment for independent house cleaners.
It's an exponential shift. Suddenly, their marginal costs for marketing, for customer acquisition, and for service delivery, they all operate at internet scale. They run the service through a central app, they take a decent margin from the service provider for the lead, and their costs actually decrease as they onboard more people. They've transformed a low-margin, non-scalable service into a high-margin, scalable platform. That's the pivot you need to be aiming for. But on the other hand, the sources also offer this fascinating counterexample that challenges the whole giant market idea. They reference the highly specialized business of sending tourists up to the International Space Station, which costs something like $50 million per ticket.
50 million. So a market that is maybe the inverse of giant. Maybe it accommodates one visitor every few years, yet it's viable. How?
Because it meets those other critical factors. It has an extremely high dollar value ticket price, extremely high profit margins, and effectively 100% market share in a highly restricted niche. And on top of that, customers pay in full, in advance, which completely resolves any cash flow issues. So while this isn't scalable in the digital sense, it shows that viability can be achieved if you check at least 3 of those 5 boxes, as long as the price point is high enough.
That brings us to the core requirements. If you are building a venture fundable business, what are those 3 characteristics of true scalability that are, absolutely non-negotiable?
First, the business has to be able to start small.
Huh.
We constantly see founders who propose these huge global platforms that require like $5 million in proprietary hardware just to test the concept. That's a non-starter. Unless you are, a true oligarch, or as the sources humorously put it, you can somehow raise the $8.1 quadrillion required to build a Death Star. Your ideal startup has to be fundable from personal savings or early revenues. Bootstrapping has to be possible, even if it's painful.
That contrast, 8.1 quadrillion for a Death Star versus starting with a few thousand, is key to setting that financial bar low for the launch phase.
Second, your marginal costs must drop over time. This is the acid test of scalability. It just means each additional dollar of revenue has to cost less than the previous one to obtain. Look at software or digital content, like Amazon's Kindle publishing business. The cost of that first digital copy is high. You have development, formatting, but every copy after that is nearly pure profit. If your business requires you to hire another person or buy another truck every time you want increased revenue by 20%, you are just not scalable.
And third, scalability needs to be built into your business model, not reliant on some special, scarce outside factors. You can't build a profitable model that depends on recruiting a never-ending supply of people with extremely rare skills, like, finding new xylophone virtuosos for every new location. The processes and inputs have to be easily replicable and readily available in the general marketplace.
Right. Once you've validated that the idea is truly scalable, you need a blueprint. And this is where we need to emphasize that necessary pivot from tradition. The old, thick, static business plan, that 50-page document you wrote once for a bank loan and then filed away, it's just obsolete for a high-growth venture.
The lean business plan is essential because it's a constantly reviewed and updated framework. It's intended primarily for the founder and the internal team. It's an internal management tool, not just some external static pitch document. And that's critical for managing constant change, which is one of the core principles of lean planning.
Precisely. The first principle is do only what you'll use. A lean plan avoids waste. It's a collection of essential decisions, measurements, lists, and forecasts, not necessarily a single monolithic document with flowery prose. Its main purpose is management efficiency. You only write the extra descriptive stuff for outsiders when you have a business plan event, like preparing for investment due diligence.
And the second principle is so vital, it assumes constant change. This is really counterintuitive. People often think planning reduces flexibility, but when it's done correctly, it actually builds flexibility. By creating a framework of expectations, you can rapidly see when you deviate and adjust course without losing sight of the long-term vision.
We also have to stress the distinction between planning versus accounting. Your financial projections are just that. They're projections. They will be wrong, maybe wildly so. Their purpose isn't perfect prediction. It's about setting realistic internal expectations and clearly connecting the links between spending, so your costs, and revenue, your results. Accounting looks backward with exact detail. Planning looks forward with summary estimates. Don't confuse the two, or you'll just paralyze yourself trying to perfect a forecast that, by definition, can't be perfect.
So, if it's not a thick document, how is this lean plan structured? Our sources detail a pyramid. Strategy at the top, so long-term visions, tactics in the middle, how you get there, and concrete specifics at the base.
And the concrete specifics are the most actionable and measurable part. They include milestones, specific metrics, assumptions, and the crucial review schedule. The single most important component of any business plan is that review schedule, because it sets the plan into the context of active management. It ensures it doesn't just sit on a shelf.
Right. This review schedule operates on what they call the PRRR cycle plan: run, review, and revise. And the sources insist that the review stage has to be a dedicated, non-negotiable management function.
Absolutely. Founders have to dedicate specific time slots. For example, the first Monday morning of every month or every week or every quarter, solely to comparing their actual performance metrics against the plan's projections. If your revenue is 20% below forecast, you have to stop and diagnose why. If you skip the review stage, the plan is useless. This rigor is what distinguishes an active management tool from an inert document.
And within those concrete specifics, the importance of identifying and listing assumptions cannot be overstated.
No, it can't. By listing things you assume to be true, for example, that your cost of customer acquisition will be under $10, or that a key supplier will remain stable, you create a baseline of expected reality. So when performance deviates, you can distinguish whether the problem is poor execution on your team's part or simply a changed assumption out in the marketplace. That clarity is vital. If a competitor unexpectedly raised the cost of raw materials, that's a changed assumption. It requires a strategic revision, not necessarily a failure of your sales team.
So the plan is solid, but a plan in a vacuum is useless. Before you take one step further, you have to avoid that classic mistake of thinking you're operating alone, what the sources call the naivete trap. Claiming our business has no competition is not a sign of genius. It is a sure sign of amateurism.
It's the ultimate red flag for any serious investor. With over 500,000 startup profiles on platforms like Gust, the odds that no one else is doing something similar is, well, literally 1 in 500,000. A sophisticated investor understands that a lack of apparent competition suggests one of two things. Either the founder completely failed to research the market, or there's no genuine market need to begin with. It's counterintuitive, but a field with competitors is often easier to enter because others have already paved the way and validated the demand.
Okay, so how do we acquire these competitive intelligence techniques? The sources really stress that founders need to get out of the office and get their hands dirty. The most foundational method is shoe leather research.
You have to objectively try to be a customer yourself. Sign up for their product, buy their offering, navigate their checkout process, and talk to their customer service. You need a first-hand, visceral feel for their product quality, their sales techniques, and their speed of service. This is something you can't just outsource to market research reports.
But there is a necessary ethical boundary here. Founders have to avoid deceptive practices. Don't lie about who you are. If you're not the target demographic, ask someone who is a team member, a friend, an external consultant to conduct the research. The goal is information, not espionage.
Right. And beyond the product experience, the evaluation needs to go deep into the competitor structure. You have to learn their business models.
Mhm.
A rival might appear vulnerable. Maybe they're offering a suspiciously low price point, but they could have underlying financial strength. Maybe they have large, non-competitive revenue streams from a different product line that makes them much harder to beat in a prolonged price war. Or they might have achieved a scale that lets them reduce their marginal costs to zero in a way you haven't figured out yet.
And once all that data, the quantitative and qualitative, is collected, it needs to be processed into something actionable. This is where competitive visualization comes in. And the simplest and most effective tool for this is the competitive grid.
Yeah, this is a schematic, often just a simple spreadsheet, that displays your analysis. You select 4 or 5 key performance categories that really matter to the customer, things like price, quality, delivery speed, features, service. And then you rank all your known competitors, including yourself, on these categories, maybe from 10 for highest performance down to 1 for lowest.
The power of the grid is twofold. First, it forces you to be objective. Second, it fundamentally simulates the customer's decision process. By visualizing where you rank relative to your rivals, you can objectively identify the precise areas where your offering needs improvement or where a genuine defensible advantage already exists to make sure you're the most attractive choice in the marketplace.
Exactly.
Yeah.
Okay, so that's the plan. Now we move on.
We transition now from the abstract plan to the concrete team. Silicon Valley loves to debate the essential partnership, the techie versus the business guy. But our sources suggest this is a huge oversimplification. Success requires 3 essential, distinct components that have to be present in the founding team.
That's right. The first component is the easiest to identify, the idea. The second component is execution skills. This is the functional expertise, the world-class coding, the sales proficiency, the financial and operational know-how needed to bring that idea to life. And crucially, these skills are available in the marketplace, often for a high salary, because they're tangible and they're measurable.
But the third component is the most unique, the most scarce, and the most challenging to define: the entrepreneur.
The entrepreneur is the one who combines the vision, the strategic leadership, the passion, the commitment, the communication skills, the fundability, and, most importantly, the willingness to take asymmetric risks. This function is what catalyzes the other pieces. It secures the capital, and historically, it reaps the lion's share of the rewards.
But let me challenge that for a moment, because this is where a lot of friction happens in founding teams. If the execution skill experts are the ones building the code and generating the first dollar of revenue, why does the entrepreneur, who is mostly vision and risk, get the largest share? Isn't that, fundamentally unfair to the engineers and operators?
That's a critical and often very emotionally charged question. The answer lies in separating quantifiable effort, what we call sweat equity, from the intangible entrepreneurial value. While the execution team is vital, the entrepreneurial value is the scarcity factor. It's the ability to secure the investment, to define the market, to convince the first 10 customers to buy a product that barely works, and to maintain the conviction required to attract the next round of world-class talent and capital. This leadership and risk willingness is the fuel that takes the company from a cool project to a massive enterprise. If the execution experts leave, they can usually be replaced, but if the core entrepreneur leaves, the company often dies. The equity reflects that terminal risk.
That really reframes the debate around risk, not just labor. The sources include the psychological profile of the founder, and they describe the founder's life as simultaneously inspiring and quite scary and masochistic.
It's a life of difficulty sleeping, where weekends lose all meaning, where relaxation is accompanied by guilt, and where the founder becomes addicted to solving seemingly impossible challenges. It is learning to respect the duck, paddling frantically like hell underwater while presenting this smooth, calm, visionary surface to your employees and investors. It's a high-stress, high-stakes psychological game.
This profile forces you, the listener, to self-reflect. Do you genuinely have that high-risk personality, or are you better suited as a highly valued co-founder focusing strictly on execution? Being honest about that determines the ideal partners you need to find.
And once the right people are together, setting founding expectations is imperative to avoid conflict later. You need crystal clarity up front, and it has to be documented in writing. Define the roles, the required time commitment, is it full-time for everyone, and the resources being contributed, whether it's financial, IP, contacts, or technology.
And most critically, one member must be designated as having ultimate decision-making authority, the entrepreneurial CEO.
Without a single point of decision, The company risks being locked in indecision, which is the most deadly scenario for a high-growth startup that needs to execute fast. You can consult, but ultimately someone has to be the tiebreaker.
This leads us right to the thorny issue that derails countless early-stage ventures, the danger of equal equity splits. The sources are absolutely unequivocal. The logical, simple 50-50 division is the wrong way to divide equity.
Equity is forever. It is the lifeblood of the future company. A simple 50-50 split ensures immediate deadlock if the two founders ever disagree, which they inevitably will. The allocation has to be rational, based on mutual agreement, using a framework like the founder equity table, not just a handshake based on friendship.
Let's detail that concept of value separation again. We need to separate quantifiable effort, the sweat, from the intangible entrepreneurial value created.
Right. You might have slaved 18 hours a day for 5 years, valuing your time at a reasonable rate. But if that effort, combined with your vision, led directly to a $2 million pre-money valuation in your first investment round, the entrepreneurial value is primarily that $2 million uplift, not the cumulative hours you spent. Equity is a share of the future upside, and it has to be rationally held by those who are instrumental in making that upside real and fundable.
The sources provide the founder equity table as a guide, detailing the factors that have to be balanced when allocating equity. The value of the original idea, the business plan execution, domain expertise, commitment and risk, using that classic analogy that the chicken is merely involved with breakfast, but the pig is committed and clearly defined responsibilities. A rational, numerical approach ensures accountability.
And finally, the single most important protective measure that must be in place before you take a single dime of outside money. Reverse vesting is mandatory.
This often sounds punitive to founders, but it's really about company protection. Can you explain the mechanics?
Reverse vesting ensures that all co-founders, even the CEO, earn their equity over time. It's typically over 4 years with a 1-year cliff. If a founder leaves before the company reaches its full flowering, the company can recapture the unvested portion of their equity at a nominal price. This is absolutely non-negotiable for serious investors.
And why is it so crucial?
The sources stress that more companies blow up due to not having reverse vesting in place, allowing a departed, undeserving founder to walk away with a large, valuable, illiquid share, than for almost any other structural reason. This massive outstanding stock creates a toxic situation for new investors and for employees. Reverse vesting protects the remaining partners and the company's ability to raise money and attract future talent by ensuring that equity remains tied to continued commitment.
Okay, so once you have a team and an idea, you have to formalize the business entity.
Right, incorporation. It provides 2 essential benefits. First is limited liability, which means company failure doesn't bankrupt the founders personally. Your personal assets are generally protected. And second is the ability to issue shares, which is mandatory for taking outside investment, hiring employees with stock options, or acquiring property in the name of the business.
And for high-growth startups targeting venture capital or serious angel funding, the sources are crystal clear. There is only one choice, the Delaware imperative. You have to incorporate as a C corporation in Delaware.
This is a point of frequent friction for founders who don't live in Delaware, but it is non-negotiable for professional investors. Why? Because Delaware has the most advanced flexible corporate statute in the world, and crucially, the highly respected Court of Chancery.
What's so special about the Court of Chancery?
It's a court dedicated exclusively to complex corporate law matters, and it's ruled by specialized judges, without juries. This translates to consistent, predictable rulings and a massive body of well-established case law. VCs demand this predictability. They want assurance that if a legal dispute arises over corporate governance, they know precisely which laws and precedents will apply. Incorporating in, say, California or Texas just adds legal uncertainty which investors refuse to finance.
And we have to issue a strong caution against the DIY cost approach here. Some founders try to save a few $100s by incorporating cheaply online.
That is almost guaranteed to be a false economy. Investors demand perfectly correct documentation, compliant bylaws, properly structured stock agreements, a valid stock option plan. If your cheap online service used generic, non-Delaware specific documents or failed to correctly issue founder shares, you are almost guaranteed to spend thousands, possibly tens of thousands of dollars later just to have a securities lawyer fix your initial mistakes.
So you have to lawyer up the right way. A good startup attorney is worth their weight in gold. They provide essential formation, organization, validation, and valuable relationships in the VC ecosystem.
But when you're selecting counsel, the sources stress one non-negotiable quality: deal closing ability. An effective lawyer understands that their primary role in a funding round is to facilitate the transaction. They work to get the deal done without nitpicking non-material details or overreaching on minor legal points to the extent that the whole transaction dies. You need someone experienced in startups and securities law, not just a general practice lawyer.
Once incorporated, what are the primary legal essentials that this corporate counsel manages post-incorporation?
The list is the foundation of all future fundraising. It includes applying for the SS4 for the Employer Identification Number, or EIN, drafting the bylaws, formally documenting the organizational actions of the board, creating advisor and board agreements, and managing the critical stock grants and 83B filings.
Let's focus on that last point, because it often confuses founders but has massive tax implications. The 83B filing. You said it was crucial, but why, specifically?
This is an internal revenue filing that founders must make within 30 days of receiving their founder stock grant. Because founder stock is issued at a nominal price, say a fraction of a penny per share, the founder files the 83B election to declare that low value to the IRS today. This effectively freezes the tax valuation at that very low price.
And what happens if they miss that 30-day window?
If the founder misses that 30-day window or just forgets to file, they will be taxed on their stock as it vests over the next 4 years. So if the company is successful and the share price rises to, say, $5 per share before those shares vest, the founder has to pay ordinary income tax, the highest rate on the difference between that initial fraction of a penny and the $5 price. This could potentially bankrupt them if they don't have the cash to cover that tax bill. By filing the 83B, they ensure that future profit is taxed at the much lower capital gains rate when there's a liquidity event, protecting their personal wealth.
That detail alone justifies finding experienced counsel. Finally, we should touch quickly on patent reality. Many founders assume a patent application is like a shield against all competitors.
It's important to have realistic expectations. Filing a patent does not provide immediate protection. The process is extremely lengthy, often taking 5 to 10 years to even issue. And critically, defending a patent in court can easily cost $1 million or more in legal fees. So while patents provide necessary validation in fields like biotech or deep tech, founders shouldn't assume they grant an automatic, unassailable claim on economic value. It's protection for the long haul, not some short-term shield.
Okay, as we move into day-to-day operations, founders have to develop a deep, intuitive understanding of business finance. We need to distinguish the 3 Business Finance 101 documents because confusing these can be fatal.
There are 3 core documents every founder has to understand, even if they aren't the CFO. First, the income statement, or the P&L. This lists revenues and expenses over a period of time. It tracks theoretical profits and losses. If revenue exceeds expenses, you are theoretically profitable.
Second, the balance sheet. This shows assets, what the company owns, and liabilities, what it owes, at a specific moment in time. It gives you the company's net worth. It's a snapshot.
And third, the lifeblood of the business that determines survival, the cash flow statement. This shows real money flowing into and out of the company over a period. This is where the timing of payments and receipts lives, and it is the single most important document for day-to-day survival.
Let's use the source's powerful example to illustrate why income and cash are not the same thing.
Imagine you land $1 million contract with a huge retailer like Walmart. They accept your product and they promise to pay you, but their terms are net 90. That $1 million immediately goes onto your income statement, making you look theoretically profitable. On paper, you're rich. But because you won't actually see the cash for 3 months, the cash flow statement shows that money hasn't arrived, and you still have to pay your engineers next Friday. This timing difference is why the saying "cash is king" exists. Positive income does not guarantee positive cash flow, and a lack of cash, regardless of theoretical profit, kills more startups than anything else.
To manage this timing difference, founders need help, which necessitates the accountant-bookkeeper split. What are their distinct roles in a lean, early-stage company?
You need a certified public accountant, a CPA, for the high-level strategic setup, setting up your chart of accounts, ensuring you're compliant with tax laws, handling eventual tax returns, and the audits that investors require. The CPA is the strategic partner. The bookkeeper, who is often a monthly freelancer at first using QuickBooks or Xero, handles the daily, weekly, or monthly cash flow. Invoicing, reconciling bank statements, managing payroll, tracking expenses, they are the tactical operators, keeping the machine running.
And separately, the company needs a strategic plan for credit profile management. Startups have to establish a separate business credit account immediately upon incorporation.
It is a critical scaling step. Using personal credit carries huge risks. Founders not only face higher personal interest rates, but also risk damaging their personal credit, potentially risking personal assets used as collateral. Building a separate, strong business credit profile is essential for future lines of credit and favorable supplier terms. And the foundation of this profile is the DUNS number.
The DUNS number, issued by Dun& Bradstreet, it acts like a business social security number. It's mandatory for joining key scaling platforms like the Apple Developer Program and, more importantly, for enterprise sales. Large partners and enterprise customers often mandate a verified business credit profile before they'll engage in large transactions.
It's a prerequisite to playing in the big leagues. Obtaining this DUNS number is free, and it immediately establishes the basis for the business credit profile tracked by agencies like Experian, Equifax, and Dun & Bradstreet, whose D&B scores range from 0 to 100. It is a non-negotiable step for high-growth ventures.
In terms of banking and credit, how should a startup navigate this complex landscape?
Well, founders need a dedicated business checking account and, crucially, a dedicated merchant account or payment processor, Stripe, Braintree, Square, to accept credit card payments, which is a primary form of modern transaction. For credit itself, high-growth startups struggle to get long-term, fixed-interest term loans initially, since they lack history. Revolving lines of credit are often better for short-term debt management. We should also mention government support. SBA-backed loans, specifically the 7A and microloan programs, are viable options for early-stage small businesses that have been incorporated correctly.
Technology has fundamentally redefined how businesses operate and scale. The modern SaaS advantage means a small startup can instantly access infrastructure and tools that rival the efficiency of a Fortune 100 company, often with a negligible monthly subscription fee.
Right, the initial decision involves office suites and hardware. While Microsoft is still the dominant traditional choice globally, Apple's integrated ecosystem often provides a seamless, secure, and stable experience favored by many US-based tech startups, just due to its stability and ease of device management. However, Google Apps has made rapid inroads, offering a free, purely cloud-based suite that is highly effective for collaboration and ease of use. The key is to standardize across the team.
Then there's the behemoth, the cloud hosting battleground. We've moved from owning expensive servers to relying on massive third-party infrastructure providers. The sources list the 5 competing giants.
Amazon Web Services, AWS, is still the largest and the industry leader. They offer the most features and really set the technical standard. But they face intense competition from Microsoft Azure, Google Compute Engine, IBM SoftLayer, and Rackspace. The excellent news for high-potential startups is that this cutthroat competition results in intense efforts to capture the next successful unicorn. They often offer special free tiers or heavily discounted service credits, sometimes worth tens of thousands of dollars, to entice high-potential startups onto their platform early.
And once the core infrastructure is chosen, we need essential workflow platforms. These are the best-of-class tools that ensure efficiency and prevent chaos across a growing, distributed team.
Standardizing these tools is vital for scaling. For project management, systems like Trello, Basecamp, or Jira manage fluid, lean development schedules, providing transparency on who is working on what. For team communication, Slack or Microsoft Teams reduces email clutter and centralizes discussions. Customer support needs a system like Zendesk or Freshdesk to manage requests from the initial report through to resolution.
And finally, managing the outward face of the company requires social media management tools like Hootsuite or Buffer.
If a scaling startup isn't eventually using one or more standardized, centralized solutions from each of these categories, it is likely relying on messy email chains and personal spreadsheets, which is a guaranteed recipe for failure as the team expands past 5 people.
Okay, so once your product, even the minimum viable product, the MVP, is launched, the entire focus shifts to measurement. The MVP is used specifically to establish objective baselines.
Baselines for what exactly?
Well, baselines for every critical metric, right? Click-through rates, sign-up rates, conversion rates, churn rate, and the holy grail customer lifetime value, or CLV. These baselines are the starting point against which all future product changes, marketing campaigns, and price adjustments are measured. If you don't know your current conversion rate, you have no way to objectively assess if your new marketing spend is effective.
This necessitates adopting the rigor of experimentation. This is the scientific method applied directly to marketplace optimization, testing value and growth hypotheses with real data. And our sources give us the golden rule for accurate results. And the golden rule is crucial for diagnostic clarity. Founders must test one and only one hypothesis per experiment. For instance, if you're trying to increase signups, you cannot simultaneously change the product's core functionality and change the price point. If signups jump, You will never know which factor was the cause. This rigor ensures you can correctly attribute cause and effect and avoid wasting time pursuing inconclusive changes.
And the standard industry tool for this is A/B testing or split testing.
A/B testing is defined as comparing different versions of a product or a marketing approach simultaneously across two randomized customer groups. Group A sees the control version, Group B sees the test version. This is the only reliable way to draw inferences about which approach is objectively more effective. You can A/B test everything from the color of a Buy Now button to the headline of a new landing page.
A more sophisticated analytical tool the sources discuss is cohort analysis.
Cohort analysis is essential for understanding the impact of changes over time. It groups customers based on when they came into contact with the product, say the June 2024 cohort, and then tracks their behavior as a unit. So if you change your core product design in July, you can compare the long-term retention of the June cohort to the July cohort. This prevents metrics from being obscured by just lumping all customers into a cumulative average, which often hides valuable data about the success or failure of specific changes.
Analytics must then be used to study key growth levers. For instance, product pricing.
Pricing is not a fixed cost. It is a hypothesis to be tested. Experiments can yield really surprising results. It's not uncommon for a startup to find that a slightly higher price attracts more, or at least better customers, because the higher price point is associated with enhanced quality or exclusivity. Never assume you know the optimal price without testing it.
You also use data to analyze channel effectiveness, testing various traction channels, social media ads, content marketing, PR, to find the most powerful and cost-effective acquisition tool that drives high CLV customers.
And finally, you have to map the customer decision process. How do customers become aware of the product? What specific trigger moves them from awareness to interest? What questions or objections do they raise just before the purchase decision? Mapping this journey allows you to fine-tune your messaging and your sales funnel to maximize that ultimate purchase decision.
Now that the business is operational and measured, we have to focus on governance. Post-incorporation, you are legally required to have a board of directors. And the board's official purpose is to represent the shareholders' rights and viewpoints, essentially acting as the fiduciary check on management.
And what does that composition look like, especially after outside funding arrives?
Well, the composition typically balances three interests. You'll have common seats, which are filled by founders, who represent the common shareholders. You'll have investor seats, filled by the lead angel or VC partner, representing the preferred shareholders. And ideally, you'll have one or two independent seats, filled by experienced, objective mentors who are acceptable to all parties. The goal is to avoid management having too much power or investors having too much power.
The leadership structure often creates confusion. Let's clarify the distinction between the chairman versus CEO.
The CEO is the highest-ranking full-time employee. They're charged with executing the day-to-day operations, and they report directly to the full board. The chairman, on the other hand, is the senior person on the board itself, usually not a full-time employee, who runs the board meetings, sets the agenda, and consults frequently with the CEO between meetings. The chairman facilitates the board's function, the CEO runs the company. It's a structure designed for checks and balances.
And when you're assembling that board, you want members who contribute using the 3 W's of board members. You need people who move the needle.
The 3 W's are simple but powerful criteria. They should deliver wealth, investors who can fund future rounds or secure capital, work-specific active skills like opening doors for business development or leading strategic recruiting, or wisdom-smart, objective mentors who provide sage, unbiased advice when the CEO is facing a crisis. You should never populate your board with managers, personal friends, or family members. You need objective business experience.
To maximize the board's value, the sources provide clear board meetings best practices.
Early-stage ventures typically meet 4 to 6 times a year. The CEO has to act professionally, sending a full, detailed information package, financial reports, KPI updates, operational summaries, several days in advance so directors can prepare. A firm, standard agenda should be followed, and critically, every meeting must end with a mandatory executive session.
Explain the executive session. This is the detail often only known by those in the inner circle.
The executive session is required protocol. The CEO and all management must leave the room at the end of the meeting. This provides the outside directors, the investors and independents, a private, confidential opportunity to discuss management issues, executive compensation, or strategic concerns without management present. This mechanism is crucial because it allows directors to perform their oversight role objectively without having to demand a secret session, which usually signals deep distrust.
And separate from the board of directors is the board of advisors. How do they differ legally and functionally?
Advisors have no legal role or fiduciary responsibilities. They are typically influential industry experts, valuable contacts, or highly visible people who provide validation for the company's direction. They are generally compensated with options, often at about half the level of directors, and serve primarily through ad hoc, one-on-one relationships with the CEO, rather than participating in formal, structured meetings. They are sounding boards and connections, not fiduciaries.
Okay, funding. The process that turns future potential into immediate cash. Let's map out the funding stages. The ladder you have to climb, defined by the typical amount raised.
At the bottom rung is bootstrapping friends and family, so under 150K. Next, you enter angel territory, which is about 150K to 1.5 million, secured from individual angels, angel groups, or micro VCs. Then you graduate to early stage VC, which is 1.5 to 10 million, and finally later stage VC, over 10 to 20 million, which funds that rapid scaling.
But the sources remind us of the harsh reality, and it's essential to maintain perspective. The investor triage. Only about one company in 40 seeking angel funding actually receives it, and for VCs, the odds are even more brutal, sitting around 1 in 400. You are fighting an uphill battle.
That's why investors use rapid heuristics to triage the massive deal flow they receive. The primary heuristic is the referral source. The most effective, and often the only way to reach a professional investor, is to be introduced by someone who knows and trusts both parties. A cold request is exponentially less likely to yield a response than a warm introduction from a trusted venture partner. Personal connections are vital in this ecosystem.
And when you launch a round, you cannot succeed without the lead investor. What is their fundamental role?
A lead investor is critical because they validate the entire round. They have to commit a significant amount, 25 to 50% of the target raise, and most importantly, they set the terms in a detailed term sheet. Once the lead investor validates the deal and sets the terms, it makes the decision much easier for follow-on investors who can simply decide to take it or leave it on the established validated terms, which reduces their due diligence burden.
Now for the classic puzzle, the valuation math trap, which is often misstated in public discussions. Let's use the standard example. If an investor offers $1 million for 25% of the company, what is the company worth today?
We have to distinguish between pre-money and post-money valuation. If the investor's $1 million buys 25% of the company, that means the $1 million represents 1/4 of the total value after the money is in the bank. Therefore, the post-money valuation is $4 million. 1 million divided by 0.25. The pre-money valuation, what the company was worth before the cash arrived, is $3 million. So 4 million minus the 1 million investment. This calculation has to be second nature to any founder.
Once that valuation groundwork is laid, let's explain the mechanics of the convertible note. This loan equity hybrid is the dominant instrument for seed stage investing.
Convertible notes are temporary loans that convert into equity later, typically when a larger, more experienced investor sets the definitive valuation during a Series A round. They're used because it's just really difficult to value a brand new company. Because the early angel investor takes the greatest risk, the note converts with two key protective provisions to reward them.
First, a discount.
The discount is typically 10 to 30% off the price the later investors pay, giving the early angel cheaper stock, rewarding them for their early commitment.
And second, the cap on the valuation.
The cap is the critical element. It sets a maximum valuation at which the early investor's note will convert. Let's say the cap is set at $5 million. If the founder uses the seed money to create astronomical value and the Series A round comes in at a $25 million valuation, the early convertible note holder converts their loan at that $5 million cap valuation, while the new investors are paying at $25 million. This ensures the early investor is dramatically rewarded for taking that initial risk before the company's value skyrocketed.
That's critical for listeners to understand. It's not about today's value, but about protecting the risk taken early on. Finally, what pitch materials must the entrepreneur be prepared to provide for investor due diligence?
Beyond the 90-minute pitch meeting, you have to be ready to provide a concise, one-page overview or teaser document, a comprehensive executive summary, a high-quality handout slide deck, and a thoughtful business plan or business model canvas. Due diligence itself is a massive process where you provide countless documents to verify every single claim you've made about the company's structure, its IP, and its history. Preparation has to be seamless.
And every venture has an end. For a high-growth startup, there are 4 possible endings that turn theoretical value into cold, hard cash. Let's focus on the most common for high-growth ventures.
The vast majority of successful tech startup acquisitions, particularly those in the $10 to $40 million range, fall under acquisition by acquihire. Here, the primary justification is not the revenue or even the product, but bringing the founding team, their unique ideas, and fresh talent onto the acquiring company's payroll. The team is the primary asset being purchased.
So what are the consequences of being acquired this way?
Because the value is attributed to the team itself, the acquirers always lock the founders into long, binding contracts, typically lasting 2 to 4 years, specifically to ensure the team stays put and doesn't take the walking away money and immediately start a new rival company. This transition often requires the founder to switch from being an entrepreneurial risk taker to a corporate employee.
At the opposite end of the spectrum is the dream exit, the IPO complexity.
Going public is immensely difficult and costly. The average cost for an IPO is $3 million just for underwriting and legal fees, and it requires compliance with the most onerous legal and regulatory requirements. Realistically, an IPO is only viable for companies that have achieved massive scale, typically with revenues exceeding $100 million. And a successful public launch requires a challenging roadshow to attract Wall Street interest. It remains a goal for only a tiny fraction of startups.
But regardless of the exit path, whether it's a massive IPO or a modest acquihire, the sources tell us that the founder's cycle is remarkably consistent.
The vast majority, over 95% of successfully acquired entrepreneurs, find themselves immediately returning to Chapter 1, ready to translate their next idea into another scalable business. Once you master the checklist and the process, the challenge of creation becomes an addiction. The journey of the entrepreneur is not about the exit itself, but the challenge of creation and mastery.
To synthesize the most critical elements for the learner who wants to build a scalable, fundable venture, success really hinges on 3 pillars: clear structure, legal rigor, and objective data.
The structure is provided by the business model canvas, which ensures the idea is scalable, and the lean plan, which has to be a living, breathing management document, constantly reviewed via that PRR cycle.
The legal rigor is the mandatory Delaware C Corp status, which gives investors the predictability they demand, the correct post-incorporation documentation, and crucially, the non-negotiable requirement for reverse vesting and the 83B filing to protect the company's equity and the founder's personal tax status.
And objective data comes from disciplined measurement. Using your MVP to establish hard baselines, applying the scientific rigor of experimentation testing one hypothesis at a time, and utilizing cohort analysis to truly understand what specific changes drive sustainable growth.
Which brings us to our final provocative thought. And this addresses the core philosophical challenge inherent in the scalable startup journey. This is the issue of percentage of equity ownership, which founders often misunderstand. They tie themselves in knots trying to maintain a high percentage of ownership.
But the secret is to always maximize the absolute value. A founder who owns 1% of a company valued at $100 million has $1 million in wealth. A founder who owns 10% of a company that's stuck at a $1 million valuation has $100,000. The mathematical reality is that you must always maximize the total value of the enterprise, even if it means sacrificing control or percentage ownership to bring in the world-class partners and investors needed to achieve that exponential growth.
The ultimate success lies not in the size of the slice, but the size of the pie.
Absolutely. Thank you for joining us on this deep dive into the definitive blueprint for building a high-growth, scalable business. If you're ready to take the leap, remember the vast entrepreneurial ecosystem Angel Group's accelerators, Score R, and Experience Council is out there ready to support you. We'll see you next time.